Chapter 1. Financial Management. Explain the different ways of classifying financial markets. Learning objectives. Describe the cycle of money, the participants in the cycle, and the common objective of borrowing and lending. Distinguish the four main areas of finance and briefly explain the financial activities that each encompasses. Explain the different ways of classifying financial markets. Discuss the three main categories of financial management. Learning objectives. 5. Identify the main objective of the finance manager and how that objective might be achieved. 6. Explain how the finance manager interacts with both internal and external players. 7. Delineate the three main types of business organizations and their respective advantages and disadvantages. 8. Illustrate agency theory and the principal agent problem. 9. Review issues in corporate governance and business ethics. Definition of finance. Finance is the art and science of managing wealth. It is about making decisions regarding what assets to buy/sell and when to buy/sell these assets. Its main objective is to make individuals and their businesses better off. Definition of financial management. Financial management is generally defined as those activities that create or preserve the economic value of the assets of an individual, small business, or corporation. Financial management comes down to making sound financial decisions. 1.1 The financial intermediary function. Financial intermediaries assist in the movement of money from lenders to borrowers and back again. This process is termed the cycle of money and its main objective is to make all the participants better off. Figure 1.1 The money cycle. 1.1 The cycle of money. The movement of money from lender to borrower and back to lender from borrower, see page 4 of textbook. Example, you invest money in a venture capital group that invests in new business ventures. This is typically a very risky investment. The pooled funds are used to support a variety of business ventures at the early startup of the company. As the new startups take hold, they are able to generate cash flow with their business ideas and pay back the venture capital firm. Usually the liquidation event enables the venture capital firm to make a sizable gain in its initial investment. All participants are generally better off from this cycle of money. 1.2 Overview of finance areas. 4 main interconnected and interrelated areas. Corporate finance. Investments. Financial institutions and markets. International finance. 1.3 The financial markets. Forums where buyers and sellers of financial assets and commodities meet. Financial markets can be classified by the type of asset traded, the maturity of the financial asset, money market, capital market, the issuer of the financial asset, primary market, secondary market, the owner versus seller of the financial asset, dealer markets, auction markets. 1.4 The finance manager and financial management. Determines the best places to borrow money. Determines the best repayment structure for the borrowed funds. Ensures that financial obligations are met on time. Ensures that sufficient funds are available for carrying out daily operations. 1.4 The finance manager and financial management. Financial management involves 3 main functions. Capital budgeting, use of funds. Capital structure, source of funds. Working capital management, timing of funds. 1.5 Objective of the finance manager. To make investment and financing decisions that increase the cash flow of the firm, thereby maximizing the current stock price. Profit maximization versus stock price maximization. Why are they not the same? Which one is more important? Sprinter versus distance runner. 1.6 Internal and external players. Financial managers have to interact with various internal and external stakeholders. Internal players include all the departmental managers and other employees. External parties include customers, suppliers, government, creditors. 1.7 The legal forms of business. There are three main legal categories of business organizations: sole proprietorship, partnership, corporation. Besides these three main forms, some other forms of business organizations include hybrid corporations, not-for-profit corporations. 1.7 The legal forms of business. Sole proprietorship. Advantages: simplest and easiest form of business. Least amount of legal documentation. Least regulated. Owner keeps all profits. Disadvantages: owner pays personal tax rate on profits. Obligations of the business are sole responsibility of owner, and personal assets may be necessary to pay obligations. Personal and business assets are commingled. Business entity limited to life of owner. Can have limited access to outside funding for the business. 1.7 The legal forms of business. Partnership. Advantages: agreements between partners may be easily formed. Involves more individuals as owners and therefore usually more expertise. Larger amount of capital usually available to the business, compared to proprietorship. Disadvantages: assets of general partners are commingled with assets of the business. Profits treated as personal income for tax purposes. Difficult to transfer ownership. 1.7 The legal forms of business. Corporation. Advantages: business is legal, separate entity from owners. Owners have limited liability to obligations of the business. Easy to transfer ownership. Usually greater access to capital for business. Owners do not have any personal liability for default. Disadvantages: most difficult business operation to form. Double taxation of company profits. Most regulated. 1.8 The financial management setting, the agency model. Agency relationship. Agency conflict. Why does it arise? How can it be minimized? Principal-agent problem. Agency theory. Agency costs. 1.9 Corporate governance and business ethics. Corporate governance deals with how a company conducts its business and implements controls to ensure proper procedures and ethical behavior. The Sarbanes-Oxley Act, enacted in 2002, requires that the CEO and CFO attest to the fairness of the financial reports. The company maintains an effective internal control structure around financial reporting. The company and its auditors assess the effectiveness of the controls over the most recent fiscal year.